I keep getting this question from some of our investors that in case of PMS, the returns which is shown and the returns which is there in the paper actually has huge difference. So what is the reason behind it? Can you throw some more lights?
So the reason behind that is very simple, Vikas. The reason behind this has to go back to the genesis of the PMS industry, which pretty much runs on a model portfolio basis, right? So a model portfolio works in the sense I have certain set of stocks, I have certain set of exposures. If you come tomorrow, that's how the portfolio I replicate. So if I have a stock which is done well for me and its exposure has gone up, I keep buying the same stock at the higher valuation for my new set of investors, right? So which means initially I am going to create a drag, right? So that is historically how the industry works and has scaled. Now, is it right or wrong? That's not for me to comment. But all I know is we would not do that. We think it's suboptimal for investors, which is why I maintained to you in the presentation in the beginning that we don't run model portfolios, right? So, which is why if you don't run model portfolios, what does it mean? It means that you will take some time to deploy your capital, right? Which is what I keep telling. In many cases, we've taken up to 6 months to deploy capital. I have not been shy of maintaining cash at all, because the third part of the presentation that I shared in our philosophy is do not overpay. So when the business is not available to me at the right price, I'm not going to ramp it up to our full exposure, which means I am going to maintain cash, right? So these are things that we do at ITUS. But if you're asking me why the industry returns are not what is represented in the fact sheet, it's unfortunately because of the way model portfolios are constructed.
So in your case, what return goes to SEBI when it is you are also authorized SEBI registered portfolio
So it
manager?
is the weighted average return of all our investors put together. So what that means is, assume that I have had inflows in the last 5 months, okay, and I am maintaining 40% cash, okay, which means if I'm in a bull market, I will underperform, yes, which means my weighted average return will also be less. So my older investors might have a reasonable upside because they are almost fully invested, but my newer investors will take some time to get fully invested. So the TWRR that we represent to SEBI takes care of all of this. So if there is a cash drag, then that has to get into the portfolio returns as well.
Okay, so essentially, I would say that it's going to be an average returns of all the investors put together.
Correct. It's the time weighted average return.
Time weighted average, yeah.